company financial statements, and in this module we will discuss the statement of financial position, which we know it is also known as balance sheet. So we will discuss that what are the components of statement of financial position and how those components are presented in the statement of financial position, and what are the different classifications into which those components are presented. So please be attentive to learn this component or the statement of financial position thing in accordance with the requirements of IFRS. When we say components of financial position which are required, in fact there are three main components which we have to present in the statement of financial position. Number one is asset, which will be further subdivided into non-current assets and the current assets. Then comes liabilities, which are also subdivided into non-current liabilities and current liabilities. And then comes owner's equity. So these are the three main components of statement of financial position, which are further classified into subcomponents. So we'll see that in the current assets, means in the assets, first of all, when we divide it into current and non-current, so the current assets cover, in fact, the assets which are held for trading. All right. Either those are the inventories which are held for trading, or those are the investments which are held for trading. These are the current assets, the first thing. Then assets which are held for consumption. Mostly it is the inventory which we hold for consumption in our ordinary course of business. And then comes those assets which are recoverable in 12 months period. 12 months from the date of the reporting. Okay. So from the end of the reporting period onwards, we will count 12 months. And if we'll say that these are recoverable in those 12 months, it would be our current assets. And then comes cash and cash equivalents. These are in fact the cash in hand and the bank balance. Okay. And some investments which are highly liquid and very short term and readily convertible into cash. These are known as cash and cash equivalent. So all these are in fact the current assets. And whatsoever is not a current asset, if any asset that does not fall in this category, that would be non-current asset. So while preparing statement of financial position of a company style of business, we have to take special care of classifying our assets into current and non-current. All right. And then comes liabilities. In the same way, the liabilities are also classified into current and non-current liabilities. When we say current liabilities, it also covers the liabilities which are held for trading. Question arises that liabilities are held for trading. How come? Yes, the liabilities are also held for trading. These are the financial instruments which are in fact the derivatives. So we do trading for the derivatives. And for those derivatives, when we are having some loss thing with us, that becomes our financial liability. So those derivatives which we hold for doing trading, buying and selling, these liabilities come under the current liability classification. Then comes which are expected to be settled within the 12 months period. All right. So which are expected to be settled in normal operating cycle, and then comes which are payable in 12 months period. All right. So when we say normal operating cycle covers that our organization would be having our process of generating cash and starting from the day when we started our operations. Okay. In a way, for simple concept, keep this thing in your mind that when we place an order for buying a raw material, we start our operating cycle. Then what we do, we put that raw material in the process of finished goods. The goods are finished. Then those goods are put for sale. Those goods are sold. Then accounts receivable arises. Okay. Then finally cash is received. So from the date of ordering the raw material till receiving cash against that, this is one operating cycle. So the thing is that if operating cycle is more than 12 months, but it is something normal for an organization, then should we take it in current liabilities category or non-current liabilities category? In the same way for the current assets and non-current assets as well. If it is going beyond the 12 months thing, if normal operating cycle is going beyond the 12 months thing. So the standard guides us that if the normal operating cycle is more than 12 months, then any recoverable or anything which is settled in that normal operating cycle will be taken in the current asset or current liabilities classification. So keep this thing in your mind that normal operating cycle can be for more than 12 months. Then any liability which is not a current liability is non-current liability. It is classified separately in the statement of financial position. All right. Well, then comes the third component, which is the owner's equity. This owner's equity is in fact a residual interest in the assets of the entity after meeting its liabilities. So once the liabilities have been met, then what we do, whatsoever is left with us out of those assets is in fact the right for the owners. So these are the owner's equity, which in fact covers the capital and reserves. When we say capital and reserves, it means capital is in fact telling us the amount which is contributed by the owners. Okay. And reserves are representing the generation of resources within the entity. So in fact there are two sources, two sort of like you can categorize this owner's equity into two sources. One is which is given by the owner or contributed by the owner, and the second one which is generated by the entity by itself. That makes the owner's equity in total. Well, the format of statement of financial position will look like something as we are presenting in this table, that are resources which are the non-current assets, covers fixed assets, investments in properties, long-term investments, which cover in fact investments in equity, debt or bonds, long-term deposits, long-term prepayments, long-term loans, and long-term receivables. Okay, so what we do, we put all these non-current assets here and we get the total amount of non-current assets in the outer column. Remember one little thing, that all these are the international accounting standards or international financial reporting standards which in fact regulate these heads of accounts. So IAS 16 is about tangible fixed assets, which is property, plant and equipment, and then IAS 38 is about intangible assets, okay, so on and so forth. So references are here, that which accounting standard regulates which head of account. Okay, well, then comes current asset. So current asset includes, as we have already discussed, that the criteria of identifying current asset is that should be recoverable in normal operating cycle or within 12 months, or is consumable within the upcoming 12 months, or cash and cash equivalent, or held for trading. Okay, so these are the inventories which are either held for trading or are held for consumption. Accounts receivable which are recoverable in normal operating cycle or within 12 months. Short-term investments which are with us either for trading or for within the 12 months period it will be recovered, cash and cash equivalent thing. So all these current assets are placed in a column and its outer column will show the total, so that we have these non-current assets with us and current assets with us. Then there is a presentation in which we have to work out working capital. So in order to work out working capital, we subtract current liabilities from the current assets. So we know all the criteria of identifying current liabilities. So place all current liabilities under the current asset, subtract the total of current liabilities from the total of current assets, we'll get working capital. And this working capital figure along with the non-current assets figure gives us the capital employed figure. All right. So what we see that this is a format in which we are showing our altogether resources side, and this is working capital, which is in fact added in the non-current assets to have this amount of working capital. Okay. So here we have mentioned this thing. Well, the next part of this statement of financial position is the part in which we show that these resources were financed by the sources, which are in fact the claims. When we say sources, so the sources include, or the sources of finance or the claims include owner's equity and non-current liabilities. So in the owner's equity, as I have told you, owner's equity includes the contributed capital and the capital or the equity generated by the organization for the owners. So contributed capital includes your ordinary share capital, okay, and share premium. All right. Then we have to show other components of equity items, which are explained in IAS 32, and revaluation reserve, plant replacement reserve, dividend equalization reserve, any other named reserve, general reserve, or retained earnings as well. So all these are owner's equity. So total of owner's equity is taken to the outer column, and non-current liabilities, which include our loan stocks, bonds, preferred shares, or loan from financial institutions, lease liabilities, or the defined benefit obligation, less plan asset if the liabilities are greater than the assets. This is something that we work out for employee benefits, post-employment benefit, and then deferred tax liabilities placed here. Total owner's equity and liability, non-current liability, gives us a figure which is exactly equal to the capital employed figure, which in fact we worked out over here as well in this resources section. So resources are equal to the sources. These sources are owner's equity plus non-current liabilities. Well, the important tips to remember in this module are, in fact, there's only one ITTR to this module, and that is that classification should be followed consistently throughout the years, over the years. We cannot change classification. Okay, whatsoever classification we have done should be consistently followed. All right. Thank you.